Hi, folks. Jayce Lowe here at Lighthouse Financial, financial planner, wealth manager here with the firm. I wanted to do something new here. About every quarter, we're going to have financial planning topics. And the one that we have today is Java with JC. So these are fourth quarter planning topics. I like to splice these up because it is a lot to take on during the year. There's a lot of financial planning tools that every client, every individual person at all ages can use at any point in their life. And it's good to break those up every now and then to have everybody be able to take advantage and kind of see how they can benefit their life. So let's go ahead and get started into this. So if you've got your coffee, if you're virtually with me and you have some coffee, tea, water, whatever you like to drink, just go ahead and take some sips, and hopefully this is very educational for you. Okay, fourth quarter planning topics. We're going to talk about life, disability, long-term care insurance, open enrollment for Social Security and Medicare planning, property and casualty. I also touch a little bit into umbrella coverages that's in there. And then we talk about end of year tax planning. So one thing to consider, the end of the year is not the best time to do tax planning, but there is one thing that you can do at the end of the year for tax planning purposes, and that's going to be on capital gains and losses. So we'll kind of touch on that. But I just kind of wanted to put that preface in there that the end of the year is not the best time to do all of your tax planning. This is just one part of it. So, all right, let's go ahead and get started. Life insurance. So life insurance, the ways that you can benefit your life, ways that it can help you in situations that might occur. How much do you need? Not everybody needs life insurance, but these are some questions that they have. How much do they need? Well, you need to take into consideration your family, everyday expenses that you have, any mortgage or major debt that you don't want to saddle your family members up with if something was to happen to you. College and expenses and any other educational needs that kids or grandkids or anybody else that you want to take care of, and then funeral costs. So the industry standard in insurance terms is typically going to be about 5 years worth of your salary, but that's just a basic, example of how you can use it. A basic example is if you make $140,000 a year, that's just your salary. You don't want to add anything else into it. You multiply it by 5, you're going to need $700,000 worth of life insurance. But is that going to be enough for you? Is that going to be enough to handle all of your needs that your family's going to need once you're gone, once you've left this world? And there are a lot of things to consider inside of that. So it's not just salary. There's a ton of other things, that you can take into consideration. And there's a lot that we can go into this. I don't want to go a ton into it. But there is a lot more that can go into how much do I need. So what types of policies? So very easy term policies. It's the cheapest option. It's the easiest to qualify for. 5, 10, 15, 30-year policies. I'm not one to tell anybody term policies are the way to go, or whole life's this, or universal. There's every need and function for life insurance in anyone's life. Or anyone's financial plan. So term policies or whole life policies, it really is your situation. Term policies are the easiest. There is a risk outside of that too, right? If you get a term policy and if it's for 30 years, what are you going to do once you reach that 30 years and all of your life insurance is basically up? So it's going to fit a need. And we'll talk about the reason why you have life insurance a few other bullet points down. Universal life and whole life. Whole life is more of an expensive option, but you're guaranteed coverage up to 110, 120 years old. But it's a fixed flat premium. Whenever you get the life insurance policy, it's exactly what that is for your entire life, unless you have any other situations or riders inside of that life insurance policy. And that's one thing that you want to take a look at and notice in your policy is if there are any adjustments with premiums of inflation or anything else, you want to make sure that you read it, because there are some situations where your whole life policy can increase in premiums. And that's kind of more of a conservative basis. The whole life is conservative because it's going to be exactly what you need for your entire life, but you're going to pay on it for your entire life. So that's one thing to consider. Universal life, that one's going to be a little bit more flexible in premium payments. You're going to have cash value options. You're going to have an investment tied to some of the cash inside of that can lower your premiums. There's basically not a ton of options and a ton of reasons why you'd want to do any of these for any substantial dead set reason. It's whatever fits a bullet point in a checklist of everything you want inside of a life insurance option. Term policy is the easiest, and you're trying to fill a need. Benefits of life insurance is it's tax free to the beneficiaries. Uh, that's basically one of the biggest benefits of life insurance. It's tax free. You pay into it. The insured, you're never going to be able to benefit from it. But if it goes to your family, it's tax free. Should you always have life insurance? That's kind of a situation where you don't always have to have life insurance. There's a reason why you do it. You're bridging a gap, and it's an asset gap. So your life insurance is there to fill that bridge of if you don't have the assets to hand to your family once you pass away, life insurance is there to fill that gap. Because as we all know, life insurance premiums, yeah, unless you get it when you're young, life insurance premiums are going to increase. Your health is only going to get worse. And that's not a slight to anybody. That's just old age. We all get older and we can't live forever. So premiums are going to go up. Should you always have life insurance? My opinion has always been once you get older in your life, you gain access to assets, whether it be IRAs, you start trust accounts, you have savings, you have everything else. That life insurance is there to fill that gap and fill that void, to bridge and to grow your assets. Once you reach a certain point in your life, you really don't need it if you have the assets to back it up. If you don't have the assets to back it up, life insurance is definitely a good benefit to your life. So, common life insurance questions that I get and I've received from clients in the past. What is a free look? So, you don't hear this much if you do buy a policy, but you do have a free look period. The free look period can be 10 days, it could be 15 days. This is the point in time where you pay for the policy. It's kind of like taking a test drive with a car. So you pay for the policy if you really like it, or let's say you pay for the policy, take it home, and then you start reading the contract and you see some things you don't like. You do have a free look period to where you can tell the life insurance policy, hey, or life insurance company, I don't like it. I want my money back. And every insurance policy has that. So be aware of that. You can look and see if you can pay for it and then do your homework. And, because salesmen inside of life insurance are pretty good at what they do. It's not to bash on them, but they can't tell you everything that's inside of that policy. So that free look period is once you pay for it, once it's yours, you get it, then you can start to dive into exactly what it is. And even before that, you can get free examples, and you can ask the salesman or salesperson to send you everything that you need to take a look at that policy. And that would be the time to do that. So you don't really have to get to the free look period, but you do have a free look period inside of insurance policies. Will insurance companies turn down applicants? Yes, they will. If your health insurance or if your health is not where their actuaries want it to be, that is one of the biggest reasons why you can get turned down if that life insurance policy has any exclusions on it. They can turn you down. So yes, you can get turned down. There are all kinds of commercials about no health exam life insurance policies. They're out there, but they also are very, very picky on who they want in their pool of insured people. So what's the difference between term and permanent? I think we talked about that a little bit, but term is it's going to be for a term, so a period, 5, 10, 15, 20 years. Once it's up, you do have the option, do you want to renew? But it's going to be a lot higher than what your term policy was. Permanent is if you get it at 30, it's going to last until you stop paying or whenever you pass away or when you reach 110, 120, whenever it's paid up. What does fully paid up on a permanent policy mean? Fully paid up means that you have put all of the premiums inside of it. Easy example is if you have a $50,000 life insurance funeral policy, that's fully paid up. If you paid $50,000 and you have that, that's fully paid up life insurance. You don't owe any premiums on it. It's fully paid up. So when's the best time to apply for life insurance? Obviously, when you're young. When you're young and spry and you've got everything going for you and your health is good, that's the best time to do it because you won't have any kickback from insurance companies. Even though they're going to ask you about your family history, they're probably going to draw your blood. They're going to do everything else inside of that to make sure that you are exactly in the health or in the range where they expect a person your age to be. But you want to apply whenever you're young. All right, disability coverage. So I wanted to add this in there. This isn't for a lot of our retired clients because you don't have disability coverage, but this could be for children, grandchildren, friends, family that might have disability coverage or need it. It's good to talk about it. So what is disability coverage? Obviously, disability coverage is going to cover you if you're injured and you cannot work. So it can cover a portion of your income if you're unable to work inside of that period. So a lot of things to take away from disability policies. There's a few nuances with it that you want to make sure if you do have a disability policy that you want to make sure that you are aware of. So one of them is a waiting period. So waiting period, it's typically going to be 7 days. It can be longer. But the waiting period is when they actually are going to qualify you to be disabled. So inside of that, the short-term coverage and some coverage terms that you can have is if you get short-term coverage, it means that you're going to return to that job in 3 to 6 months. So that to them is short-term. Long-term coverage is anything longer than 6 months. So if you do get a policy, it typically will benefit you on basically what you can afford in that time period. If you can only afford short-term coverage, if you can spend a little bit more in long-term coverage and getting that advanced coverage on that, you can. But those are just the situations that you want to make sure that you take a look at. Do you need long-term coverage? Well, it depends on, it could be your history with when you get hurt. Does it take your body a long time to recover? Or can you kind of get by, with a month or whatever it is? If you break your arm, break your leg, it's a huge disruption, but you want to make sure that your life can kind of go on. So another question, and this may not be a lot of questions that we get, but this is a good question to talk about, is disability insurance or the proceeds taxable. So if you, well, let's kind of talk about the first one. If your employer pays for your disability coverage, because they do have employer policies, if your employer pays for the coverage, it will be taxable as income, the proceeds that you receive from it. If you do it outside of work on your own and you pay for the premiums, it's not taxable. So those are the two differences. So takeaways, disability coverage, it's a great way to reduce your risk. If you get injured, and to also fill that void, if you don't have enough in savings or emergency fund and you do depend on your current paychecks, it's a good thing to have. Now, another thing to consider is insurance premiums are always going to go up. So it's a good idea to eventually find a way for you to build up your savings so that you don't have to depend on disability coverage, saving in emergency funds and everything else like that. So some tips with disability coverage: make sure your benefit period is long enough that you can benefit from it. So if it's 30 days, that might cover you for an accident, but what if you need 60 days? So you want to make sure, again, we talked about it briefly about the coverage period. You want to make sure that you have enough coverage inside of that. And if you don't, you need to be aware of that, and you need to have some savings. The waiting period, elimination period, it's the time between your accident and the time you get the benefits. So if you have a waiting or elimination period of 30, 60, or 90 days, you will need to have savings built up inside of that. And insurance companies are notorious for taking a long time to get you your benefits. You don't ever want to assume that it's the 7-day period that we were talking about. In some cases, whenever you submit it, you're going to have to follow up with other uh, approved doctor's notes and everything else with them saying, yes, this is what happens. It can be a pretty decently long time for you to receive those benefits. Um, how much in income coverage should you have? You want to have between 60 to 70% of your income. And that's what you want your disability coverage, those checks to be. So this is kind of like the Aflac commercial, right? So you see the duck and you see them a bunch if you watch sports or TV, but this is the Aflac coverage. So keep in mind that this policy can coordinate with other benefit programs like state benefits. So you can have workers' comp. Social Security also has a disability. That one's a lot harder to get approved for than just basically getting hurt. Or even your employer can provide programs. So you want to kind of be aware, especially if your job is physical in nature and you're going to need to be getting up and moving around. You can't work from home. You can't do anything else like that. You need to be aware that in some situations your employer can provide coverage. It's just the one case that if your employer pays for it, you're probably going to have to owe some taxes at the end of the year. Application process. It's not always guaranteed that you're going to receive coverage. Um, but your personal info, your employment info, income, medical history, and lifestyle information, all that's going to be up to them whether or not if they approve it. So just keep that in mind. It's always not always a guarantee. Okay, long-term care. So received a lot of questions about long-term care and assisted living and everything else inside of that for some of our aging clients and just people in general. They're asking questions about long-term care. So long-term care is private insurance that helps you pay for services that people need to do to disability and prolonged illnesses. So long-term care, what's considered long-term care? So there's 6 daily living situations every single day that you can check off. And if you cannot complete 2 out of those 6 daily life activities, they're going to deem you available to get long-term care insurance or long-term care coverage. So just a few of those sixes are bathing, dressing, using the toilet, transferring to and from, carrying, or eating. So you can be considered to receive long-term care assistance if you cannot complete 2 out of those 6. So, but it's not always guaranteed. So just make sure that you have that in mind too. So what is the best age? And this is really a short, we're going to get into the other thing here in a second. So what's the best age to get long-term care? It's going to be between 40 and 55. So again, the older that you wait for any insurance, the older you wait, it's going to get more expensive. So should you wait until you're 60? No, because it's going to be really expensive. And most clients were just having to self-fund long-term care insurance. So questions to ask before you get long-term care insurance. Does the policy include protection against inflation? So this is a big deal, and it has been a big deal for the past 3 to 4 years is inflation. You want to make sure that your policy can protect against inflation and will go up. The benefits will go up as time goes on. Does this policy guarantee level premiums? Level premiums are obvious. It's going to stay flat. It's going to stay level. Are there ways that they will protect you and guarantee or grow with it, however they can benefit you and move those premiums forward? You don't want to have to be paying a lot in premiums if you get a policy because insurance companies do change. They can sell off to other companies, and at that point, if they want to rip up the contract, I mean, I guess they can, but you really want to make sure on the contract that you have as well that it does protect against level premiums. Does this policy cover home health benefits, nursing home care, skilled or intermediate care? This is a big deal inside of that. If you get hurt, it's going to want to make sure that they can actually come to your house and care for you. It's not like any sort of thing where you have to be in a hospital or you have to be here. You want to have a little bit of flexibility inside of that. So is there a maximum benefit period? That's another question you want to ask. 1 year more. Long-term care, the older that we all get, if we have any illness, it's going to take us a lot longer to recuperate. So you want to make sure that those maximum benefit periods are longer than a year. Is there a renewal on the policy? You want to make sure that it can renew and it automatically renews. So what is the waiting period and deductible? And is it affordable? So you want to make sure obviously it's affordable. The waiting period, kind of like what we talked about with disability, is what is the waiting period of when they are going to give you your benefits inside of that. So, and also what does the policy cover? Dementia, Alzheimer's, anything else that, congestive heart failure, which I don't think it'll really cover a lot of that, but you have some other things inside of that and questions that you can ask. And if they are specific to your health and your family history, I would absolutely ask if it covers, any of those. But dementia and Alzheimer's is big. I would ask them if they cover that. Okay, open enrollment on Social Security. So we're hitting that point for a lot of people. If you're planning to retire, Social Security for a lot of our clients is a big deal. And it's when should we take it? What should we be aware of? So you want to apply between ages 62 and 70. So that's when you can receive it. Obviously, if you wait every single year up to about age 70, now it's at the full retirement age up to age 70, you get an 8% bump every single year that you wait. So you can receive, obviously, you can receive Social Security as early as 62, but your payout's going to be smaller than your full retirement age. So full retirement age for a lot of people, if you're born 43 to 54, it's 66. If you're born 60 and after that point, it's 67. So those are the full retirement age, and you see that on your Social Security statement at FRA. And it'll have your FRA amount of however many quarters that you've worked inside of that. So when to apply? So you want to apply, and I've heard a lot of really good feedback from clients that have dealt with Social Security. And it's really made me happy that Social Security is willing to help people and get them the best benefit and the biggest payout that they can receive. But if you don't have the help, if you reach a person that's not very helpful, you're going to want to apply anytime up to 4 months before you want to receive. So if you want to receive your first check and you want that check to be in April, you're going to apply in November to March. So if you pick March on your application, you're going to receive your check in April. So that's just kind of and I would double check with the Social Security office too, inside of applying in that time period, because they do change certain situations inside of Social Security. But this is a very good example and rule to take. So we've also had questions from our clients is when is it the best time to take the Social Security check? When should I apply? So we run a lot of our clients through what's called a Social Security analyzer. So we basically take their payout options at whatever age and we put it into software that we use and we analyze, and it'll basically tell us your annual amount, and you can also pick what if I lived until 95. So if your payouts were at a certain point, we started to plug these in here, we'll tell you probably what the best time to take it, but then we'll also throw in there, especially in this situation, if you're 62 and you're debating and I'm 62, I don't need it, but what if I waited until I'm 70? That's what you'd get at 70, $3,403 every single month. So your annual and then your total if you waited. So this is the total payout, and it kind of shows you the difference of if you waited. So it's $123,000 higher than those. So all of those signs can point to age 70. You can basically look at this and say, yes, I can wait. But in some situations, your family health history may tell us, well, the individual is actually only going to live to, maybe 80 in those situations. And that's when this might not be as high. It might be better to take it at 66, or it might be better to take. So it's whatever with your benefits inside of that. You want to make sure that if you do have some health history, you are giving up a little bit of freedom. You're going to have other assets. If you're going to wait until 70, you want to make sure that your other assets won't be just completely drained so that you have to wait until 70. But keep in mind that if you do take it early. You can't say, oh, wait, I want to take it at 70. You really can't do that. So another benefit inside of this or thing to think about is if you have a spouse and if you make more money than your spouse and that spouse is younger than you and you want to give them your Social Security benefit, but you two have the benefits to live on. If you can wait until you're 70 and if you pass away before your spouse can get your payout, which would be higher. So in some situations, if you're banking on giving your spouse a higher benefit, this would be something to consider is waiting. So, but when to take it, it's always going to be with your scenario. We run multiple scenarios with clients of when to take it. So this isn't a thing to consider. Some other tips inside of Social Security, and this is a bone that I have to pick with our government, but you can withhold taxes from your benefit payments, 7 to 22% on your monthly statements. So keep in mind too, up to 85% of your benefits may be taxable if you're single or if you're joint. If you're single and you make more than $34,000 a year, up to 85% of your Social Security benefits will be taxable. I don't know anybody that can live on $34,000 a year. And if you're making around that, but they can take your benefits. So you've been taxed on them when you're working, and now you're going to get taxed on them whenever you're retired. So keep this in mind. And this really isn't, I don't want it to sour the point of planning for Social Security, but this is one thing to consider for taxes as well. And even if you're in your joint filing area, our joint filers, if you're making more than $44,000 a year, 85% of your benefits can be taxable. So, that is one thing to consider. Survivor benefits. So if your spouse passed away, you may be eligible for survivor benefits starting at age 60 or at age 50 if you're disabled. Also, if your spouse passes away and you receive lower than their benefits, you can actually receive their benefits if it was higher than yours. And then the last little orange bulletin, don't forget to file your SSA 1099 on your taxes. So in some situations, you got to make sure you watch for that in the mail whenever you're filing for your taxes. Sometimes you don't get it, but just make sure you do have to file that. They don't file it for you. Okay, open enrollment for Medicare. So Medicare eligibility requirements for Medicare. You must be age 65 and older, or you have end of stage renal disease, or you're permanently disabled, or you have ALS or Lou Gehrig's disease. So those are the eligibility requirements for Medicare. So there's multiple parts of Medicare. Part A is the hospital coverage. So it's inpatient care, hospital, skilled nursing, hospice care, limited home health inside of Part A. Part B is going to be medical coverage. So it's outpatient, doctor visits, certain tests and screenings, chemo, PT, diabetes, medical equipment, and whatnot. It's going to be in medical in Part B. Part C, it's going to be your Medicare Advantage plans. So it's gonna include all of Part A and B, and then it also gives you some additional benefits like dental, hearing. You're gonna find Part C with private insurance companies that are approved by Medicare if you use it. So the Advantage plans and some of that, and it has been beneficial for clients that use it. And then Part D is your prescription plan that you have inside of that. So drugs and everything else. So Part D has been benefits. Now Medigap. So what about Medigap? So Medigap is the supplemental plan. It's sold by private insurance companies, and it helps with out-of-pocket expenses. So it's kind of like a bridge with if a certain limit of Medicare didn't reach, the Medigap is there to fill that gap and help you pay for it. So definitely would make recommendations to get every piece of this Medicare pie that you can if you can afford it. So, and affordability. This is another kind of tax planning issue going into the end of the year where you're going to see where you're at. So this is the Medicare premiums. They go up the more money that you make. So if you file as a single filer, and you make less than $97,000 a year, your adjustments to your premiums are not really going to go into effect. Um, if you make more than a certain amount, you're going to look at paying a higher benefit. And the same for joint filers. If you make less than 194,000, you're not really going to owe that much, and it's basically going to be just a total fixed payment, 164.90. And this isn't exactly what you're going to pay, but this is just something that I grabbed that I thought was helpful. If you're making greater than those amounts, you kind of see how your income, at whatever you're making, 97 to 123, you're going to have a $65 increase, and that's on both of these, and you kind of see your total payment. So it can rise. So you want to really look at your income and control it as best as you can. In some situations, you're not going to control it, and it's best to take excess income in retirement. But the larger your income grows in retirement, it is going to affect your Medicare. So I grabbed this. I like to get a general cost just to prepare either my clients or even clients that do have Medicare on how much it costs per month. So Part A, it's typically going to be zero. So if you worked 40 quarters in your life, it's going to be free. 99% of the beneficiaries that get Part A coverage is for free. Part B is going to be about 174 a month. Medigap coverage, you're looking at 125. And then Part D at about $27 a month. So all those, is not bad. You think of having that type of insurance. And I would say this, that even if you can't wait, and this is a retirement question, 65 is a good number to wait until retire. And the reason is if you can't wait, and some people you can't, you just want to retire. If you can't wait, you have to go on the health insurance market. That market, you're going to be looking at probably $10,000 to $12,000 a year just in health insurance premiums, and that can get burdensome. That can get very expensive for clients. So if you think of if you can retire, and a lot of people can swallow those payments right there, 174, 125, and 27 a month, compared to a few $1,000s a month, or close to $1,000 a month. So is Medicare deducted from your Social Security checks? Yeah. Once you sign up for Social Security, Medicare B is deducted monthly from your Social Security payments. The next part is our Medicare premiums tax deductible? If they are, if your medical expenses exceed 10% of your adjusted gross income, then you can deduct them. But it's a case-by-case basis. I'd say about every year. Don't say that it's always guaranteed, because you don't know what your income is going to be. Well, you can guess what your income is going to be, but I would say in most cases, if you're over that 10%, it is. Okay, property and casualty insurance review. So once we all age, we get into a life of identifying risks and how we're going to handle them. We can transfer risk. So we can transfer to an insurer or an insured party. We can retain the risk, which means that we understand the risks that we're taking and responsibility, and we are responsible for the losses. We can finance those risks of setting aside funds to cover those potential losses. So typically insurance that is required for most people, you want to have a home. If you're renting an apartment or condo or anything else, they're going to require you to have renter's insurance. And if you drive a car, you're going to have auto insurance. Or if you have a business, you're going to have errors and omissions, or E&O insurance, or whatever insurance that you have inside of that business. It can be some sort of comprehensive coverage if it's a very physical job. Home policies really in the last few years have changed because states like California, there's insurance companies that have just left the state because of their beliefs and reasons of how the state has ran certain insurance with homes and making it liable to insurance companies. So there's been a lot of policies just say, we're out of here. You're not going to get our coverage, and there's been a few in California. So it has created a lot of reviewing of home policies and how to do that. So here's some quick tips for home insurance policies. what to look at when reviewing your home policy. So what coverage was quoted for your home? Does it include detached structures? So, detached garages, sheds, anything else that has valuable stuff in it. You want to make sure that you have excess or you have the coverage that if something was to happen, that it is covered under that. How much your personal belongings are covered under your personal property? Is your house insured under replacement cost or actual cash value? Replacement cost is the obvious replace how much it would cost to replace your home. It doesn't necessarily mean the actual cash value of what your home is appraising for. So there can be some discrepancies. If replacement cost might not be the actual cost of what it's going to cost to replace your home. You need to consider that as well. You really need to kind of pinpoint these insurance people on if that's the actual replacement cost or if that was pulled, if you live in California and they pulled that dollar amount from some other state, you want to make sure that that's the actual replacement cost. Now, obviously, replacement cost is going to be less than actual cost value or cash value. Cash value premiums are going to be a lot more. How much is your deductible? Obviously, the lower your deductible, that situation is going to benefit you in a few scenarios. The higher your deductible is, you're going to have to hit a certain point to be able to, that insurance is going to kick in. So how much is your deductible? What can benefit you from that? Are there separate coverages for your policy? So there can be all kinds of situations inside of that. There could be coverages that you have in your policy that some insurance providers don't provide. How a deductible works. So a deductible is the amount of money that you pay before the insurance will start to pay. So an example of that is if you have a deductible of $20,000, you pay the first 20 before the insurance starts to cover anything else. So I want to keep that in mind. Obviously, if your deductible is lower, it means that you're going to cover lower amounts. So kind of like what I was talking about. If your deductible is $10,000, that means you're going to cover the first 10. And then that's going to make your insurance higher because that means that the insurance company is going to have to kick in. So if you increase your deductible, your insurance premiums can get lower, but you have to have the excess savings for that. So tips at lowering your premiums on insurance policies. Raise your deductible. If you can stomach it, if you can foot the bill, or if you can accept that risk of having a higher deductible, then do it. So in a lot of these too, I would say they're not guaranteed to lower it. The deductible is for sure going to lower your premium. Adding or improving home security, that's not always a guarantee. I kind of saw that and I said, well, you can do other things. It depends on what kind of neighborhood you live in. It depends on what kind of security that the insurance company will approve. If you go out there and get a basic camera and you say, I've got home security, the insurance company may not agree with that. So you really need to do your research and make sure that that will lower your premium. You don't want to over-insure your home or your belongings because that's going to make your insurance premiums go up. You can reduce risks. You can always check before you do any major projects and see if it actually does lower your premiums. Risks in the area, if you've got fire and you say, I'm going to clear this brush 100 feet if you have a big property, well, that may not actually reduce the policy. So you might do a ton of work. It might make you feel better, but you're gonna be out of how much it costs you to clear brush or trees or anything else. So you want to check with your insurance company too. Fortifying the roof. You just want to make sure, again, some of these major projects, if you do fortify the roof, that it is compliant with the insurance company and what they see as fortifying the roof. Eliminating unnecessary coverage. There's a lot of coverage inside of home policies that you don't need. They're nice to have, but eliminating those is going to make your premiums decrease. You can ask about discounts. You can improve your credit score, and you should always be shopping around. Insurance policies are going to increase every single year. We've seen that, and shopping around. My grandfather used to do that all the time, is shopping around for insurance policies, seeing what better benefits that he could get. Okay, auto policies. This is another thing. The older you get, the more expensive your auto policy is going to get, but you're going to have more benefits of being able to lower your policies. So you want to always make sure that you have the minimum required amount in whatever state that you live in. So bodily injury, and this is for the state of California, is 15,000 per person, 30,000 per accident. And then property damage, it's going to be about 5,000 per accident. So if you have this minimal coverage, your insurance isn't going to be overly expensive. It's going to be fairly affordable. It's whenever you add some of the other situations inside of that. So personal injury protection. Do you need that? Well, you can. It's optional. Uninsured or underinsured motorists. That one's usually a pretty good idea to put. I usually get that on my insurance policies because you never know who's going to hit you or drive away after they hit you. And it depends on the amount of damage they do to your car. But if you don't cover it, then obviously you're going to have to cover it at the repair shop. Collision, it depends on now if you have a new car and it's still financed, they're going to require you to have collision coverage, especially if your loan isn't paid off. And then comprehensive. So these can be non-collision events, theft, vandalism, firestorms. So these three are going to make your policy go up in premium amounts. So you kind of want to you want to look at these specifically and see if it actually benefits you to add them. In my opinion, collision depends on how old the car is too. I mean, it's nice to have collision coverage, but that's going to increase it. Underinsured, I would say yes. If you want to save money on your policies, shop around every single year, see what all these other companies, I'm not going to name any companies, but see if they'll basically give you excess, benefits or savings or, typically if you're a new client or a new uh, person inside of that insurance company, they're going to give you more benefits than an existing. You want to lower your coverage and increase your deductibles to save. If you can benefit from it, if you can foot that expense, if something major was to happen, then do it. You can drop collision and comprehensive. You're transferring risks. You want to remember that you're transferring risk to your liquid cash or your credit cards or whatever else. Discount programs, there's defensive driving classes, there's good driver programs, there's all that stuff these insurance companies can do. Making sure your mileage is accurate. So if you don't drive that much, you don't want to overestimate your mileage because it will affect your premiums. You want to kind of be in line and exactly where your insurance is at. Bundling coverage. So some insurance companies can be home, boat, RV, all that motorcycle. If you have all these things, you can bundle coverage and save. Paying out of pocket for accidents. So you don't have to submit insurance, claims for every ding and dent that you get. Broken windshield or, somebody backs up into your car at the Santa Barbara Pier and they leave a note on your car door. Somebody did that to us, and it wasn't a whole lot of damage to the back of the bumper. It wasn't worth going and repairing it because the repair shop's going to replace your whole bumper. It's going to cost thousands of dollars. So going through your insurance broker, independent brokers or independent agents are going to be able to shop around. So that is kind of a good tip. Now, umbrella coverage. Um, I don't want to toot the horn of umbrella coverage, but umbrella coverage, I've never met a situation where umbrella coverage didn't benefit it. Umbrella coverage is fairly inexpensive, and it will cover, it's almost like a gap coverage. So it's extra insurance to add protections beyond your existing insurance coverage. So homeowners, auto, power sports policies, anything like that. So what does it cover? So it's going to cover injuries, damage to property, certain lawsuits, personal liability, anything that was to happen. What it doesn't cover is your injuries or damage to your personal property, a criminal or intentional action causing damage to someone else, or liability you assume under a contract. So umbrella is really there to take on that excess burden. And here's a really good example is you cause a car accident. and your bodily injury limit is 300,000, but the cost of the accident is 500,000. So an umbrella policy can come in and provide the excess coverage, that extra 200,000 to push you, just to make sure that you don't have to fork out that money. So it can come in and cover that gap. So I've never met really any situation where an umbrella policy, because they're fairly inexpensive. They can be. Now they can also get expensive, but they're good backups to have. If you don't have the assets, if you don't have the credit card, if you do have a fair amount of risk, and if you don't want to transfer that risk. Okay, so now end of year tax planning. As I said in the beginning, this isn't the best time of year to plan for your entire tax situation and start to, calling up your advisor and telling them make all these crazy moves. This is the time of year to look at your unrealized gains and unrealized losses. There's a situation before we get until the end of the year where it's called tax loss harvesting. And this only works in markets or positions that you have in your portfolios that are negative, where you can rebalance with very little to no tax gain. So for instance, if you have Pfizer and Pfizer is at a loss, you sell Pfizer, you have to sell it and maintain it sold for 31 days. That 31 days will realize that loss. And then after the 31 days is up, then you can purchase Pfizer right back, or you can rebalance in any other situation if you don't want to own Pfizer or any other loss. So this is a great time to do that because you're getting closer to the end of the year and you can realize that loss. So targeting losses in your taxable accounts like joint, transfer on death, trust accounts, individual accounts, so that you can take a distribution. So all this can help on your tax tables for your 1040. If you obviously get to take losses for the year, and you're benefiting from it, that's a great thing. So again, so this is kind of the end of it. I want to do this about every quarter where they're quick little, and 48 minutes, I realize close to 50 minutes isn't quick, but I think these are good things to add value for a lot of our planning clients. So again, thank you so much for attending, and we're going to be doing a lot more of these videos, and hopefully we can add value. If you have any questions, always feel free to reach out to us. All right. Thanks, everybody. Take care. Bye.